Did Trump just crash mortgage rates? Not exactly. But this matters more than most Federal Reserve rate cut announcements, and it could be enough to push mortgage rates down 1/4 to 0.5% in the near term. All right, let me translate the headline into normal people language because the way this is being talked about online is a little spicy. The news is this. President Trump said he's directing Fannie Mae and Freddie Mac, the big government-backed housing finance companies, to buy $200 billion of mortgage-backed securities, also called MBS. In plain English, that's basically buying a giant pile of mortgages that have been bundled together and sold as bonds. And here's why this matters. Mortgage rates are priced off this bond market. So when there's a massive buyer stepping in, it can push those bond prices up, which usually pulls the yields down, and that's one of the direct pathways to lower mortgage rates. Now, quick reality check. The Fed still matters, but mostly indirectly. The Fed controls short-term rates, and that influences the overall economy. But your 30-year mortgage rate is heavily tied to the bond market, especially the MBS market. That's why you'll sometimes see the Fed do something and mortgage rates barely budge, or mortgage rates move a bunch even when the Fed didn't do anything that day. Different levers. So, what could happen next? Best case, if this buying actually gets executed quickly and at scale, it can tighten what we call the spread. Basically, the extra premium mortgage bonds pay over other bonds, that can show up as lower consumer mortgage rates. And yes, the short-term effect people are talking about is roughly 1/4 to 0.5%, not back down in the 2s or 3s like 2021. More like, if you're seeing 6.75 today, you may see 6.5 or 6.25. That's the range people are watching. Some analysts are more conservative and think it's a smaller move, like 1/10 to maybe 0.15%. But either way, even small changes can matter a lot in real life. Now, let's bring this home to Kansas City because this is where the rubber meets the road for us. For home buyers who bought in the high 6s and low 7s, you're already thinking what I'm thinking, refinance. And you're not wrong. If rates drop even 1/4 to 0.5%, a chunk of people suddenly have enough savings to justify a refi, especially if they plan to be in the house for a while. Will everyone refi? No. Closing costs still exist, appraisal still exists, credit and equity still matter. But if you bought recently and you're sitting at say 7.125, you don't need a miracle, you just need the math to cross the line where it makes sense. That's why you're already seeing refi activity pick up. It's not hype, it's just homeowners doing what homeowners do when the payment can drop. For buyers in Kansas City, lower rates can help you qualify. They can help your payment and help your buying power, but I'm gonna be very honest. In KC, when rates drop, demand usually wakes up fast because we still don't have a flood of inventory. So you may get a slightly better rate and also a little more competition. That can mean more multiple offers, tighter timelines, and prices holding firmer than people expect. So if you're a buyer, the opportunity isn't wait because rates are coming down. The opportunity is get positioned correctly. So if rates dip, you can move fast and win without overpaying. For sellers, this is where it gets interesting. If rates soften, you may see more buyers re-enter the market, and that can increase showings and offer volume. You could also see more homeowners list because the rate lock feeling eases a little, meaning people who are stuck at 3% still won't love giving that up, but if the market feels healthier and buyers are active, some will finally make the move. That's good for sellers and good for the market because we need inventory. But again, don't confuse slightly lower rates with instant affordability. We still have the big pressures like insurance, taxes, and the general shortage of homes. Now here's the part nobody wants to say on camera. Even if this works, it doesn't solve affordability long term. It's a lever aimed at the rate side of the equation, not the supply side. If we get even a modest rate drop, it can help payments, but it can also keep prices from falling because it brings buyers back into the game. So if someone's waiting for some massive price crash and a huge rate drop at the same time, that's not how these forces usually work together. There's also a risk angle to mention because we're being honest here. Using Fannie and Freddie's resources to buy this much MBS raises questions about how that's structured, how fast it's implemented, and whether it reduces financial cushions that protect the system during downturns. So yes, there can be benefits, but it's also not a free lunch. And that's why you're seeing mixed reactions from economists and housing analysts. So what's the practical takeaway for Kansas City right now? Don't get lost in the political takes. Treat this like a market signal. If you're a homeowner in the high 6s or 7s, you should be watching refi options closely because that window can open quickly and it can close quickly. If you're a buyer, don't assume rates down automatically means easier. It can also mean more competition. And if you're a seller, rate relief can bring buyers back, but pricing and strategy still matter more than the headline. If you want, I'll run this through a real-world KC lens with your exact numbers: purchase price, down payment, current rate, and timeline. And I'll tell you whether you should refinance, buy now, wait, or sell. Call or text me and I'll map out the smartest move for your situation. See you next time.